Hello to the hockey family. It is Monday, September the 22nd, which is nice. We've got some hockey back, right?
Yeah, really nice.
NHL preseason games going on.
Nice to have it back. My wife said I needed a haircut. Like, I'm not playing hockey anymore. I can't. So
Yeah.
a little easier to put some product in the morning.
You're looking fresh this morning.
I have mixed feelings.
Yeah. So, anyways, with hockey being back, it's obviously exciting for us. We've been pouring over schedules. Excited to for camps to settle down and get back out on the road.
Yeah. So there's probably a better way, probably more efficient way than we literally just print out dozens of schedules and try to match, kind of our schedule with some of the guys and families we help. So yeah, looking forward to seeing many of you here once the season starts and things settle down a bit.
It gives me a lot of respect for the logistics people that figure out schedules of multi-use buildings. It's pretty impressive. Anyway, so looking back last week, another decent week for most global markets. Biggest thing really we saw was the Fed meeting. Right?
Yeah. So as expected, Fed cuts 0.25%, right? So also known as 25 basis points. So the market is still expecting 2 more cuts between now and the end of the year, which is probably a good thing. Just particularly here in the U.S., some of the most recent initial jobless claims, other jobs employment report it's not been good. So and the Fed called this a risk management cut. So I think that's probably a good thing. So
a question that we get a lot, I guess, along these lines is when the Fed cuts rates, do mortgage rates automatically decline?
Yeah, do mortgage rates also decline with them? And we've been over this a little bit, but the short answer is not necessarily. Right now, the Fed controls this might get a little nerdy, but the Fed controls the short end of the curve, right? So the overnight lending rate. So when the Fed cuts rates, what does happen immediately is HELOC rates. So home equity line of credits, most HELOCs are tied to some kind of rate similar to the Fed. So that rate will go down. That the yield you receive in a high yield savings account, that will go down. So there are some short-term instruments that are immediately impacted, but mortgage rates, without going too deep, are more closely tied further down on the yield curve. So in the U.S., mortgage rates are most closely tied to the 10-year Treasury. Okay, and the 10-year Treasury is that price and yield is going to move more based on supply and demand. Okay, so while it doesn't necessarily go lockstep, it was let's find some data. Okay, so I found a really nice study by Dimensional that looked back a number of decades to today, just so we can more quantify the probability of will mortgages go down when the Fed's also cutting rates. All right, so just looking at the historic correlation, okay, going back into the early 1980s through today. All right, so when the Fed cuts rates like they did last week, what this study looked at was in the month following the rate cut, does that 10-year Treasury or mortgage rates, does that go up or down? Okay, and so the study showed that 64% of the time, so call it roughly 2/3, when the Fed cuts rates, over the following month, the 10-year Treasury will also drift lower, about 2/3 of the time. But that obviously means 1/3 of the time, or 36%. To be more precise, the 10-year Treasury, the yield actually increases, right? So far from a guarantee that just because the Fed cuts rates, mortgage rates will follow. So just I think some maybe helpful data because we do see some people that let's refinance, the Fed's cutting, so that's a guarantee rates are going lower or whatnot, and not always the case. So
so not necessarily.
Yeah.
Good. So, anyways, hockey's back. We're excited. We got some meetings still continuing here as we get going.
But, week 5.
So everybody have a great week. We'll talk to you soon.
See you guys.